Ever wondered how to start investing? Do you find it complex and intimidating? Well, you're not alone. The world of investing can seem like a labyrinth to those peering in from the outside. But here's the good news. It's not as complicated as it may seem. Investing is essentially making your money work for you. It's about putting your hard-earned cash into ventures that have the potential to grow over time. It's about planting a seed today, nurturing it, and watching it grow into a towering tree tomorrow. In this video, we're going to break down simple investment strategies that you, as a beginner, can understand and apply. We'll guide you through the fundamentals, shedding light on the different avenues available and providing actionable tips to help you navigate your financial journey. So, are you ready to demystify the world of investing? Let's dive right in. Begin your investment journey by understanding your goals. Why do you want to invest? This question is fundamental. It's not just about making more money, it's about what you intend to achieve with that money. Maybe you're aiming to fund a sabbatical, buy a new house, or secure a comfortable retirement. These are all valid investment goals, and understanding them is vital. Investment goals can be short-term or long-term. Short-term goals could include saving for a vacation or a down payment on a car. Long-term goals, on the other hand, might involve building a nest egg for retirement or setting up a college fund for your kids. Each of these goals requires a different investment strategy. The type of investment strategy you choose will depend heavily on your individual goals. It's important to remember that investing is not a one-size-fits-all endeavor. It's a personalized journey, tailored to your objectives and financial situation. Identifying your goals will guide you in choosing the right investment strategy. Remember, there is no one-size-fits-all approach in investing. Now that you know your goals, let's explore some investment options suitable for beginners. First off, we have stocks, which are essentially shares of ownership in a company. If the company does well, so does your investment. However, stocks can be volatile, meaning prices can fluctuate, sometimes dramatically. While this presents an opportunity for high returns, it also comes with a higher risk. Moving on, we have bonds. Bonds are like IOUs, where you lend money to a government or corporation for a set period. In return, they promise to pay you back with interest. Bonds are typically lower risk than stocks, but also offer lower returns. Next, we have mutual funds, a pool of funds collected from many investors for the purpose of investing in a diversified portfolio of stocks, bonds, or other assets. Mutual funds are managed by professional fund managers, which can be a boon for beginners who may not have the time or expertise to manage their investments. Then there are exchange-traded funds, or ETFs. They're similar to mutual funds, but they trade like stocks on an exchange. ETFs offer the best of both worlds, the diversification of mutual funds and the flexibility of stocks. But remember, every investment option comes with its own set of risks and potential returns. Stocks offer the highest potential return, but also come with the highest risk. Bonds are safer, but offer lower returns. Mutual funds offer diversification, which can help reduce risk, but they come with management fees. And while ETFs offer flexibility and diversification, their prices can fluctuate throughout the day, which can be a double-edged sword. Choosing the right investment option is crucial. It will depend on your risk tolerance, investment goals, and the amount of money you're willing to invest. Remember, investing isn't a one-size-fits-all approach. What works for someone else may not work for you, and that's okay. The key is to find the right balance that suits your individual needs and goals. Heard of the saying, "Don't put all your eggs in one basket"? It's a vital principle in investing. Now imagine if investment was a game of chess. You wouldn't place your queen in a vulnerable position, would you? That's what diversification is all about. It's like the strategy of protecting your queen in a chess game. Diversification is the practice of spreading your investments across different assets. It could be stocks, bonds, real estate, or even commodities. The idea is to not have all your money tied up in one type of investment. By doing this, you're spreading the risk around. Think of it like this. If one of your investments is underperforming, it's not the end of the world, because you have other investments that could be doing well. It's about balance. It's about not letting a single setback derail your entire investment strategy. Now, it's important to remember that diversification is about managing risk, not eliminating it. Even a diversified portfolio can experience losses. But the losses could potentially be less severe than if you were to invest all your money in one place. And let's not forget, diversification isn't a one-time thing. It's a strategy that needs to be reviewed and adjusted over time based on changes in the market and your personal financial goals. Diversification can help you manage risk, but remember, it does not guarantee profits or protect against loss in declining markets. Let's make one thing clear. Investing is not a get-rich-quick scheme. It requires regular investment and patience. You see, the magic of investing lies in a concept called dollar-cost averaging. This involves regularly investing a fixed amount of money regardless of the market's current state. Whether the market is high or low, you keep investing. This strategy does two things. It takes the emotion out of investing and it reduces the risk of making a large investment at the wrong time. Now let's talk about patience. It's easy to get caught up in the daily ups and downs of the market, but it's important to remember that investing is about long-term growth. Short-term market fluctuations are just noise. They might seem scary, but they don't affect the long-term trend. The most successful investors are those who remain patient and stay the course, no matter what the market is doing. And finally, it's worth mentioning that regular investment and patience are not separate concepts. They go hand in hand. Regular investment requires patience, and patience allows for regular investment. Together, they form a powerful strategy that can help you grow your wealth over time. So remember, investing is a marathon, not a sprint. Regular investment and patience can help you grow your wealth over time.